Thank you. Good morning, everyone. I hope everybody has joined in. I can wait for a couple of minutes before we start. Good morning, Saminathan. Let's wait for a minute so that whoever is joining in can join in and then we can start. Okay, I think we should start now. Uh, Again, a very warm welcome to everybody. The topics for the day are two indices, Index 21 and Index 37. So first of all, we'll start with Index 21, the effects of change in foreign exchange rates. I hope you must have attended the regular session on the Index and you must be able to recall the key matters which the Index 21 has brought in and what are the accounting and treatments and presentation requirements, for these items which are governed by India's 21, right? All the transactions which are happening in the foreign currency, for example, sale purchase, right? And then translation of the balance sheet of, foreign subsidiaries, foreign joint ventures or associates, right? And the translation of the company's own balance sheet from one currency to another currency, that is called presentation currency, right? So these are the three key matters which have been, discussed in detail by India's 21, and we are provided a lot of guidance, how to treat with these items, right? So I hope you must all be able to recall that there are all in all three types of currencies by India's 21. Which are those? If anybody can tell me. What are the three types of currencies?
Reporting currency, foreign currency, presentation currency.
Okay. So foreign currency is fine, presentation currency is fine, but the third currency is not the reporting currency. The currency is the functional currency, right? Correct?
Yes, sir. Functional currency.
Functional functional currency, foreign currency, and the presentation currency. What is the difference between these three?
Functional currency is the currency in which the entity is operating.
Mm-hmm. Okay. What about others? Okay, so let me quickly rewind whatever we have understood in the main classes. So functional currency is the currency of the primary economic environment in which the entity operates, right? So the primary economic environment in which the entity operates, primary economic environment, right? Then foreign currency is the currency other than the functional currency. So once the functional currency is determined for a company, then all other currencies would be regarded as the foreign currency. And the presentation currency is the currency in which the financial statements are prepared and presented, right? So can presentation currency be different from functional currency? Yes. So India's 21 allows companies to present the financial statements in any currency other than the functional currency if the entity wishes so. Correct? So that's what you must have learned in the main class. Are you able to recall
Yes,
now?
sir.
Right?
Yes, sir.
And then Foreign currency, we understand the currency other than the functional currency. And presentation currency, we understand the currency which the management chooses to prepare the financial statements in, right? So these currencies we know very well. But how to determine the functional currency? How did you determine functional currency? Are you able to recall anything from your main session? So there were two set of indicators. One is the primary, another is the secondary. Recalling?
Yes, sir. The mainly influencing the sales for the goods and services. That is a primary
Mhm.
indicator. Then competitive force and regulation mainly
Yeah,
determine the sales.
correct. So there are set of primary indicators and the secondary indicators. Primary indicators are the one where the currency that mainly influences the sale price. Influence means the sale price is influenced. What sale price, selling price the company should charge for its goods and services is influenced by that currency. So that currency could be the functional currency. So this is one of the indicator. I'm not saying on this behalf the currency will be determined, functional currency will be determined, but this is one of the prime indicator. Another indicator was the currency of the country whose competitive forces and the regulations mainly determine the sale price of its goods and services, right? So first two primary indicators revolves around the determination of the sale price for the goods and services of the entity, correct? Then the second criteria was currency that mainly influences the labor, material and other cost of providing the goods and services, right? The cost to produce goods or to provide services is incurred in a particular currency, so that currency could be the functional currency. This is one of the another indicator, right? So these are the primary indicators. Then there are secondary indicators. Secondary indicators means the currency in which funds from financing activities, that is issuing equity instruments, are generated, right? So the currency in which the company generally arranges the fund requirements for running the business, right? So funding in which currency. And the last is currency in which receipts from sales are usually retained. So once the debtors are collected, the currency in which the company wishes to hold the cash, right? So that currency could also be one of the factor to determine the functional currency. So these are the primary indicators. Basis on the appropriate mix of these conditions, we come up with the decision of functional currency, right? That's what you must have done in your regular classes, and you must have done the practical examples as well, how to determine the functional currency.
Yes, sir.
Correct. Okay. So now let's start with the question number one. And as and when we proceed, while doing the questions, whatever the concepts are there, I will keep revising those concepts for you during the question answers. Right. So question number one for India's 21. An Indian entity whose functional currency is rupees purchases USD denominated bond at its fair value of USD 1000. The bond carries stated interest at the rate of 4.7% per annum on its face value, right? So this is 4.7% per annum. Okay. The said interest is received at the year end. The bond has a maturity period of 5 years and is redeemable at the face value of 1250 USD. The fair value of the bond at the end of the year one is USD 1060. The exchange rate on the date of the transaction and at the year one are USD 40 and USD 1 is equal to 45 rupees respectively. The weighted average exchange rate for the USD 1 is 42 rupees during the year. The entity has determined that it's holding the bond as part of an investment portfolio whose objective is met by both holding the asset and to collect the contractual cash flows and selling the asset. The purchased USD bond is to be classified under FVTOCI category. The bond results in effective interest rate of the 10% per annum. Calculate the gain or loss to be recognized in the profit and loss and the other comprehensive income for the year one. Also, pass journal entries to recognize the gain and loss on the above. Round off the figures to the nearest rupees. right? So there is a bond which the company holds as an investment, and the purpose of holding this bond is to sell the asset bond as and when the cash is required, as well as to collect the interest on the bond, right? So are you able to recall something by reading these lines? Investment portfolio whose objective is met by both holding the asset to collect the contractual cash flows and selling the asset. Something similar you have ever learned anywhere? Yes, no.
Yes, sir.
Where? The classification of the financial assets under the financial instruments India's 32 and 109, right? Financial assets are classified into three categories. Number one, amortized cost.
Yes,
Number
sir.
two, FVTOCI. Number three, FVTPL. Are you able to recall that?
Yes, sir. FET, OCI, and NR category, R category.
Correct. So FVTOCI is the category where the dual objective, that is holding the asset till its maturity to collect the interest, as well as sell the asset as and when required. Right? If this is the objective, then this is categorized under FVTOCI. Right? Although this is already given in the question for your comfort. Right? The question has clarified that the bond is classified under FVTOCI category. Correct?
Yes, sir.
Now, what you need to do? You need to do the accounting for this bond, right? Now, because this bond is in foreign currency, so that's why apart from India's 32 and 109, India's 21 is also involved. Correct? Had this bond not been in the foreign currency and in Indian currency only, then there wouldn't have been any India's 21 involvement. But because the bond is USD bond, that's why 21 has also been involved along with 32 and 109, right? So this question is a perfect mix of three standards. Now, would you like to try this once? I can wait for few minutes if you want to give it a try. So you need to come up with the journal entries, how you would be recognizing the fair value gain or loss on this bond in the books of accounts. So what are the journal entries? Are you trying?
Yes, sir.
Okay, so I'm waiting for your response. Uh, any luck with the solution?
Yes, sir.
Hmm. So what would be the journal entry? Okay, what is the interest income which will be recognized in the P&L? What is the amount of the interest income?
Sir, interest income, accrued interest is 4,200, sir.
Okay, accrued interest is 4,200 in the P&L. Okay. And
Yes,
how
sir.
much is the interest which is actually received?
Received is 2,643.75.
2643.
Yes, sir.
Okay. Okay. And what is the fair value gain? Fair value gain on the bond?
It is totally is 5,300, sir.
5,300. Okay. So did you get a chance to form the journal entry as well?
Yes, sir.
Hmm. So what is that?
Sir, investment in bonds, sir. 40 the
Mhm.
47,700 minus 40,000. It's 7,700. Bank account
Mm-hmm.
interest received
Mm-hmm.
2,643.75. To interest income
Okay.
4,200.
Mm-hmm.
To exchange gain
Mm-hmm.
5,300.
Mm-hmm.
To
Mm-hmm.
OCI
Mm.
843.75.
Okay. So largely your entry is in line, except some small amount variation with the fair value gain, which you have recognized in the OCI, right? So let's see how did you arrive at the different number? All there is marginal difference, but still. So cost of the bond is 1000 USD into my 40,000, right? Interest accrued would be the 10% per annum. So 100 into my 42, 4,200. Why 42? 42 is the average rate during the year, right? So 4,200. Interest received would be received at coupon rate 4.7%. So it will be 59 USD into my 45 at the closing rate. So 2655 would be the amount. I think you have multiplied it by 42, correct?
Yes, sir.
Instead of 45, right? So why we are using 45 here? Because interest is received at the end of the year, that is specified in the question. The said interest is received at the end of the year, right? So if it is being received at the end, then it will be converted at the year end rate. Had this line not been given or mentioned anywhere in the question, then using the rate of 42 would have been appropriate, because we would have assumed that interest was paid on a monthly basis and hence it was received in 12 installments every month during the year, and hence weighted average rate should have been used. But because question specifies clearly that it is received at the year end only, hence the year end rate is being used. Clear?
Yes, sir.
So in the examination, just read the question carefully to gather what are the facts of the transactions which are happening on which dates. If you are, uh, dealing with the India's 21 question, right? Because the date becomes very crucial, because you need to apply the conversion rate for that date. And if the conversion date of the wrong date is applied, then the answer will be different in spite of the fact conceptually you are doing the right thing. Clear? Amortized cost at the year end would be 1041, that is 1000 plus 100 minus 59. So closing balance 1041 into me at the closing rate 45. So 46,845 fair value at the end 1060 into me 45 47,700. Right now, what would be the interest income which will be eventually recognized in the P&L as per Ind AS 109? That would be 4200. Correct? Because EIR is given in the question at the rate 10%, and as per Ind AS 109 in our P&L we recognize interest basis on the EIR, right, instead of the coupon rate, unless and until both are same, right? But in this question the EIR is 10% and coupon rate is 4.7%. So at EIR 4200 is the interest amount which will be recognized in the P&L as interest income. Clear? Then exchange gain on the principal amount would be 45 minus 40 into my 1000. So 5000 plus 100 into my 45 minus 42, 300. So total is 5300. I think this was the right you have calculated, correct? So 5300 you had calculated correctly, correct? Then the fair value gain to be recognized in OCI would be fair value in the USD minus uh, fair value minus amortized cost into my 45, right? So 855 would be the delta which will be recognized in OCI as a fair value gain on the bond. Correct? Here you did arrive at 843 something, right? Because of differential rate you have used here, right? Otherwise it would have been 855 only, correct? So what would be the final journal entry now? So the journal entry would be investment in bond account debit 47,700 minus 40,000 7,700, which was correct. Bank interest received 2655. To interest income 4200. To exchange gain in the P&L 5300, and to OCI fair value gain in OCI 855. Clear?
Yes, sir. Clear now, sir.
So the key learning from the question is we need to be very specific using the correct conversion rates of the dates on which the transactions are happening in this question, because we generally assume that P&L transactions are happening throughout the year. So we are, we have a tendency to use the average rate, right? Because our mind, are channelized to use the average rates for the P&L items. But if in the question it is specified that a particular, transaction is occurring at a particular date, then the rate of that date should only be used. Clear?
Yes, sir.
Okay. So let's do this question. Question number two. A is an Oman-based company having a foreign operation. B in India, right? So A is in Oman. B is in India, right? And B is the foreign operation of A. The foreign operation was primarily set up to execute a project in India. The functional currency of A is OMR, right? So OMR is the functional currency. 78% of B's finances have been raised in US dollars. So B, which is a foreign operation of A, arranges the funds or funding requirements in USD, right? 78% of the total funding is arranged in the USD. B's bank accounts are maintained in both USD as well as in rupees. So B is maintaining two accounts, one in the USD, another is in the rupees. Cash flows generated by B are transferred to A on a monthly basis in USD. So, as and when the B generates any cash after the receipts from the debtors, they immediately convert them into the USD and remit back to A on a monthly basis, right? In respect of repayment of the finance received from A, right? So they do the repayment of the finance which they have received from A. Revenues of the B are in USD. So B earns revenue in USD. That means they invoice to their customers in USD. Its competitors are globally based. Tendering for the construction project happens in the USD, and the tenders which the B participates in are all done in US dollar. B incurs 70% of the total cost of business in rupees and remaining 30% cost in USD. Since B is located in India, can it assume the functional currency to be rupees? What do you think?
Sir, USD will be the functional currency of B, sir.
Okay. Why not INR?
Sir, there are a primary condition and secondary things are there. On the
Hmm.
primary indicator, it says that it's a significant revenue and competitive force are in USD only in this
Hmm.
case.
Okay.
And also the cost incurred in INR, only 30% cost are in USD.
Hmm. So that's what now 70% cost is in
That
INR.
and also the secondary condition, if you look at that, the finance raised in the USD only, that is 78 percentage, and
Hmm.
also it's retained the cash in the USD only,
Hmm.
only
Hmm.
the partial amount in INR.
Okay.
So considering this fact, that functional currency will be USD.
Let's see. So in case these type of question comes in the examination, right? So although we need to provide our conclusion first, right? Whether the currency is the INR, USD or OMR, whatever is the functional currency, right? But we should also support that answer with the literature, right? So this is how we are going to present our answer in the examination. Although I'm not saying that you need to mention all the conditions, right, in its bare form. You can use your own language or own wordings, but you need to be able to demonstrate that you know all the indicators by heart and able to articulate. So first of all, the question was whether the management can consider INR to be its functional currency, right? So our answer should be no. We cannot presume rupees as its functional currency on the basis of its location because it is operating in India. It doesn't mean that INR would be the functional currency. It needs to consider various factors under the Indias for the determination of the functional currency. What are those various factors? One is the primary indicators, then the secondary indicators, and then the additional factors related to the foreign operation. So, what are the primary indicators? The currency that mainly influences the sale price of its goods and services. This will often be the currency in which the sale prices are denominated and settled, and of the country whose competitive forces and regulations mainly determine the selling price of its goods and services. Now, in our question, how we are able to say that this is happening in USD? Because there are two facts given in the question. Number one, that it generates revenue in USD. Number two, it participates in all the construction bidding contracts, and those biddings are happening in USD. So it means all the pricing for the projects which the entity wins is happening in USD, right? So everything is happening in USD on the sales side, right? Labor and material and other cost of providing goods and services. This will often be the currency in which these costs are denominated and settled. And what is happening in our case? In our case, 70% of the cost is happening in INR, 30% in USD, right? So 100% cost is not happening in INR, it is only 70%, right? 30% is still happening in US dollar as given in the question. other factors, secondary indicators, the currency in which the funds from the financing activities, that is issuing debt or issuing instruments, are generated, and the currency in which the receipts from operating activities are usually retained. Now, in this case, 78% of the finances are being generated in USD, correct? And repayment of those finances are happening on a monthly basis by converting the cash into the USD and remitting it to A on a monthly basis. So that means as and when the debtors are collected or the cash is generated, that is immediately converted into the USD for the remittance purpose. So they are being retained in the form of USD only most of the times. So sales are happening in USD, contracts bidding is happening in USD, 30% cost is happening in USD, 78% finance is happening in USD, and the monies are also retained and remitted in USD, right? So that's why USD is the functional currency for the B Limited, in spite of the fact it is situated in India, and 70% of the cost for providing construction cost is happening in INR. Clear? Any questions?
No, sir. Clear, sir.
Right? Now, apart from the above primary and secondary indicators, there are additional indicators as well, right? Which we use for the purpose of determination of the functional currency of the foreign operation. That's what the question is, right? So, what this guidance says, if the entity is a foreign operation, additional factors set out in India's 21 should be considered to determine whether the functional currency is the same as that of the reporting entity or different, right? So, what are these? Whether the activities of the foreign operations are carried out as an extension of the reporting entity rather than being carried out with significant degree of autonomy. What do you mean by autonomy? So autonomy means when a company is operating on its own, right? It is not dependent on any parent or any other company for running its business, right? So if the foreign operation is fully autonomous, right? It is generating funds on its own. It is deciding the sale price on its own. It is doing the manufacturing on its own. It is selling the goods on its own, collecting the cash on its own, and using the cash for various activities on its own without any interference from any other company, right? So it means it is an autonomous body operating on its own in its entirety, right? But if the foreign operation is being controlled by some other entity, right? That is the parent entity for all its operation, day-to-day operational decisions, right? Then it is not a autonomous body, right? So if the foreign operation is autonomous body, then the functional currency could be different from the reporting entity. And if it is not autonomous body and is fully dependent on the parent company, then the functional currency could be of the same as that of the foreign as that of the parent entity, right? So that's what the indicator says. Whether the transaction with the reporting entity are high or a low proportion of the foreign operations activities. So if the transactions between the parent entity and the foreign operation are very high, so it gives an indication that the foreign operation is doing most of its transactions with the parent entity or reporting entity only, and hence functional currency could be of that entity only. But if the transactions are very low and the foreign operation is dealing with lots and lots of third party customers and suppliers on its own, then it means they are doing transactions on their own, right? So they could have a different functional currency. So these are the indicators only, just to sense whether the entity is operating on its own or it is fully dependent on the parent entity. Then the third one, whether the cash flow from the activities of the foreign operation directly affect the cash flows of the reporting entity and are readily available for remittance to it. So if the foreign operation is remitting whatever the cash it is generating on a frequent basis or regular basis to the parent company, then it means they are supervised and guided by the parent for anything and everything they do, right? And if it is not the case, then they are doing things independently, right? And the fourth one, whether the cash flow from the activities of the foreign operations are sufficient to service the existing and normally expected debt obligation without funds being made available by the reporting entity. So if the foreign operation is not dependent for any cash requirements from its parent entity, then it means it is operating on its own and it can have its own functional currency different from the reporting entity. But if it is dependent for any day-to-day expenses, cash requirements on the parent company, then it means it is fully controlled by the parent company for its day-to-day operations, and hence it is just an extended arm of the main entity, and hence the functional currency would be regarded as the same as that of the reporting entity. So these are the four additional indicators which we need to keep in our mind while determining the functional currency of the foreign operation. Is that clear?
Yes, sir.
On the basis of all the above additional factors mentioned in point 3 above, B cannot be said to have a functional currency same as that of A Limited. Correct? And hence, the functional currency is USD and not the INR or OMR. Hence, primary and secondary indicators should be used for determination of the functional currency of B, giving priority to the primary indicators. The analysis is presented below. Its significant revenues and competitive forces are USD. Significant portion of the cost incurred is in rupees. Only 30% is in USD. 78% finances are raised in USD, and it retains the operating cash flows partially in USD and partially in rupees. Keeping these factors, USD should be the functional currency of the B. Right. So this is the way you need to quickly summarize. Basis you have concluded the functional currency. So in spite of the fact that we know the concept and we are giving the right answer, doesn't mean we get the full marks in the examination if we did not articulate our answer and support this with the uh, indicators, right? So we do have the indicators in our mind, but the examiner will come to know that we know the indicators only if we present them in our answer sheet in a better way, right? So presentation of the answer is quite important. Clear?
Yes, sir.
Okay. Let's do the third question. M Limited is engaged in the business of manufacturing of bottles for the pharmaceutical companies and non-pharmaceutical companies. It has a wholly owned subsidiary G Limited, which is engaged in the business of the pharmaceuticals. G Limited purchases the pharmaceutical bottles from its parent company. The demand for G Limited is very high, and hence, to cater its shortfall, G Limited also purchases the bottles from the other companies. Purchases are made at the competitive prices. M Limited sold the pharmaceutical bottles to the G Limited for the euro 12 lakhs on 1st of February 2001. The cost of these bottles was 830 lakhs in the books of M Limited at the time of the sale. At the year end 31st March 2001, all these bottles were lying as a closing stock and payable with the G Limited. Euro is the functional currency of G Limited, while the INR is the functional currency of M Limited. Following is the additional information available. Exchange rate on 1st of February 2001 83. Exchange rate on 31st March of 2001 85. Provide accounting treatment of above in the books of M Limited as well as in the books of G Limited. Also show the impact of the consolidated financial statement. Support your answer with the journal entries wherever necessary in the books of M Limited. So what you need to do? So you need to do the accounting in the books of M Limited. You need to do the accounting in the books of G Limited. That is the journal entries for both the books you need to pass on. And also in the consolidated financial statement, how this would be recorded, that also you need to tell. Whatever the journal entries you prepare, you need to support your answer basis on the India's 21 guidance, right? So this is a full-fledged India's 21 question, the way you would be expecting to have one in your examination. So I give you 5 minutes. Try it once. Come up with the journal entry. in the books of M Limited as well as in the books of G Limited. Then how the it will be treated in the consolidated books. So for your easy comfort, I am drawing the facts quickly. So MG, okay. G is based out in India. So INR is the functional currency, correct? While Indian rupee is the function. No. So INR is the
Yes,
functional
sir.
currency of M Limited and Euro is the functional currency of G Limited.
G
Okay,
Limited. Yes, sir.
correct.
For
So this
M
is
is
the functional
INR.
currency, right? And M is selling goods worth rupees 12
12 lakhs.
12 lakh euros. Okay, to G Limited, and the cost of these bottles was 830 lakhs in INR, right?
Yes, sir.
In the books of M Limited. So these are the broad facts, and these are the exchange rates for the two dates. Okay, so just try it once, giving you 5 minutes, then we will see where we reach.
Okay, sir.
Mhm. Any other? What is? Okay, let me check. Yes. Any luck with the journal entries?
Yes, sir.
Okay. So in the books of uh, M Limited, what are the journal entries?
Sir, M Limited, that the functional currency is INR currency.
Mm-hmm.
So when you are selling goods G Limited, the money is not received.
Mm-hmm.
So we will debit to G Limited account and credit to sales account with the 12 lakhs
Correct.
euro
Correct.
83 on the date of sale.
Mm-hmm.
So it comes to 12 lakhs 83. It's 996 lakhs.
Perfect.
And also when we are and that foreign exchange gain is there since the value is increased from 83 to 85, the 2 rupees 2 euro into 2 lakhs is 24, then that amount we will transfer to
Mm-hmm.
the profit and loss account.
Okay. So the entry would
Then
be
when it comes to G, yeah, profit foreign exchange gain account to profit and loss account, from where the first we
no,
will
no, 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 no,
record
hold on,
into
hold on,
the G
hold,
limited.
hold, hold on, hold on. What is the entry for recording of this 24 lakhs?
24. First, we will record G Limited. We have to receive from the amount since the amount is increased from 83 to 85 rupees. So we will be debiting to G Limited, credit to foreign exchange gain account,
Perfect.
which is not
Perfect.
yet realized.
Right.
Then finally, what we will do at the end of the year itself, we will move from foreign exchange gain to profit and loss account.
Mm. Perfect.
The, the same value, the 24 lakhs.
Okay. And in the books of G Limited, what would be the journal entries?
Books of the G Limited, only they are recording that items, whatever they purchased.
Hmm.
While you are purchasing, the cost will be 12 lakhs into 83.99. So they will record in euro only. The 12
Mm-hmm.
lakhs they will record it. Since
Okay.
their
So
currency is the EUR.
correct. So purchase account debit to M Limited 12 lakhs, correct?
But at the end of the year, when they are look at they have to, as per Index 2, the cost has to be, then the reporting data, the NRV has to be fixed. The
Mm.
reporting, they need to revalue it, right? While
Okay.
you're presenting that as per Index, the valuation of the inventory,
Mm.
cost or NRV. See, that time, the whatever the amount going to pay to M Limited is 85 now.
Mm.
So the difference are there 83 and 85 too. When we are talking about the cost or NRV, whichever is less. So again, the cost will be 83 only.
Mm.
So the 12 lakhs, it's a hold good on the year end as well for them.
Perfect. Perfect. And in consolidation, anything you will be doing?
Consolidation only that the intercompany owings, the intercompany transaction to be eliminated. Only the margin
Mm.
of the profit portion only to be reported and consolidated. They have to
Okay.
reduce from the inventory.
Okay. And how to compute that?
But that portion I did not work out.
Okay. Okay. That portion you did not work out. Perfect. No issues. So let's see. You can match the figures as well, whatever you have arrived at. So accounting treatment in the books of M Limited. So M Limited is recognizing a sale of rupees 996 lakhs, right? How the 996 lakh is computed? 12 lakh euros the sales into the 83 is the conversion rate on the date of the sale, right? So 996 lakhs the sales would be recorded in the books of M Limited, and the entry would be G Limited account debit to the sales, right? 996 lakhs. Clear? Then on this 996 lakhs, how much the profit M Limited would be earning? The sale price is 996 lakhs and cost is 830 lakhs, which is already given in the question, right? So the delta would be the 166 lakhs. So this is the profit element. The M Limited will be earning on this transaction with the G Limited. On the balance sheet date, receivables from the G Limited will be translated again at the closing rate. And the closing rate is now 85. So the transaction has happened on 83, but the closing rate is 85. So the 2 euros is the additional which we would be debiting to the G Limited. So again, the debtor account, that is the G Limited account, will be debited to the foreign exchange gain or loss, right? So, which is unrealized. So 24, 2 into me 12, right? So 24 lakhs is the additional amount which we will be reinstating our debtor on the closing date, right? So this is we generally do for all the debtors and creditors on the closing date, correct? So that is the reinstatement. Now, in the books of G Limited, because they are maintaining their books in euros and euros is their functional currency, so they would be recording the transaction in euros only, and hence there wouldn't be any foreign exchange gain or loss. So the purchases account debit 12 lakhs to M Limited 12 lakhs, right? So M Limited is their creditor, but because their functional currency is euros, the transaction is happening in euros, so there is no foreign exchange gain or loss uh, settlement happening on the G's books, correct? Accounting treatment in the consolidated financial statement, what would be? So receivables and payables in respect of the above mentioned sale will be eliminated, right, while preparing the consolidated financial statements, right? That is the normal part and parcel of the consolidation. And the closing stock, the G Limited, will be recorded at the lower of cost or NRV, right? Whichever is lower as per the index 2. Now, what is the lower? So euros is the 12 lakhs, right? Cost, and assuming, because NRV is not given in the question separately, so we will assume that it is 12 lakhs only, right? And the rate is 83 and 85. So 996 lakh is the purchase cost, and 1020 would be the NRV at the rate of 85, and hence whichever is lower, so 996 is the lower, so cost or NRV both are equal in this case, and hence there wouldn't be any write off, right? So there is no write off required, correct? The amount of the closing stock of 996 lakh includes two components: cost of the inventory 830 lakhs and the profit element 166 lakhs, right? Now at the time of the consolidation, the second element amounting to rupees 160 lakhs will also be eliminated from the closing stock, correct? So that is the normal elimination we do while preparing the consolidation. There is nothing as per India's 21 requirement on this, correct? Now, what would be the entry for this elimination? Consolidated P&L account debit 166 lakhs to inventory 166 lakhs, being the profit element of the intra-group transaction eliminated. Clear?
Yes, sir. This is a downstream of that sale.
Yeah, correct. So 166 is the profit element in the books of M Limited, and M Limited is going to prepare the consolidated financial, and hence this 166 lakh profit element will be eliminated. Is that clear?
Yes, sir.
Any questions, any doubts until now, whatever we have discussed since morning?
No, sir.
Okay. So let's do the question number 4. Entity A, whose functional currency is rupees, has a foreign operation entity B with a euro functional currency. So entity A is having a functional currency of INR, correct? And entity B is having a functional currency of euro. Okay. Now entity B issues a perpetual debt. Entity B issues a perpetual debt, ठीक है, to A Limited. The perpetual debt has no issuer call option or the holder put option, right? So neither the issuer can call for the repayment nor the holder can put it for the repayment. Thus, contractually, it is an infinite stream of interest payments in euros, right? So this is a perpetual debt, and hence the interest payments will be infinite because neither the A has the right put it back to B, nor the A has the right to call it back, right? So no party has the right to return the or cancel the loan, right? So this is a perpetual debt. Interest payments will be regular and for infinite period. Analyze in A's consolidated financial statements whether the perpetual debt can be considered in accordance with the para 15 of the India's 21, a monetary item for which the settlement is neither planned nor likely to occur in the foreseeable future. That is the part of A's net investment in B with exchange gains and losses on the perpetual debt therefore being recorded in equity. So this question is related to one of the concept being brought up by the India's 21, that is the net investment in the by one company into the another company, right? And if that net investment is if that is proved that this is the net investment, then the accounting is given by the Index 21 how to deal with that, right? Anything you are able to recall by reading this question from your main class?
Yes, sir. Since it is a perpetual debt,
Hmm,
but this is this will not form part of either in receivables or payable. The reason is that the perpetual debt upon only the liquidation only it will happen.
hmm,
So the settlement is not planned or likely occurred in the foreseeable future, which means
hmm,
that the settlement will not be happen. That is not sure about it.
hmm. Okay. So, what is the concept of net investment in a foreign operation?
Then
You
it
must
has
have.
to be, yeah, then it has to be recorded as to equity only.
Okay.
It's not there is it's a equity instrument.
Okay. So, net investment in a foreign operation is the amount of the reporting entity's interest in the net assets of that operation, correct? So, what is the net investment means? Net investment means the company who has invested in another company has a interest in the net assets of that company, correct? That is called the net investment.
Yes, sir.
And because one company is investing for a long term into the other company, so the return of this investment is neither planned nor likely to occur in the foreseeable future. That's why it is called the net investment, long term net investment by one company into another company. Correct? Can the trade receivables and trade payables be part of the net investment?
No, sir.
Why? Why? Any specific reason? Okay, suppose I give you one situation. Suppose a company, sells the goods to another company and doesn't demand the money against those sales. And they have done a master agreement that whatever the company sells will not be considered, as a amount payable by the another company to the selling company, right? In that case, whether these debtors, which are not planned to be settled or not likely to be settled in the foreseeable future, can take a color of the net investment.
Yes, sir. It is a net investment.
It is a net investment, right? So, what is the concept? The concept is it doesn't matter what is the underlying transaction, whether it is a sale purchase or whether it is a loan or whether it is a equity investment, doesn't matter. The only thing matters is whether the repayment or return is planned or likely to occur or not. If it is neither planned nor likely to occur, irrespective of the underlying transaction's nature, then the transaction will result into the net investment by one company into the another company. Is that clear?
Yes, sir.
Right? So we will not focus upon whether the company has invested into the equity of the other company or it has, given a loan or it has made a sales. Doesn't matter. The only thing matters is whether the settlement is planned or not, and whether it is likely to occur or not. If it is neither planned nor likely to occur, then it will be a net investment. Clear? Now,
Yes, sir.
what is the accounting treatment of the net investment under Ind AS 21?
It will be recorded as a equity, sir.
It will be recorded as equity. Sure.
Yes, sir.
Okay. So net investments are always recorded in OCI equity. They are never recorded in the P&L. The exchange gain or loss on them is not recorded in the P&L, right? So that's what the Ind AS 21 requirement is. Now, in the given case, what is happening? There is a perpetual debt given by the B to the A, correct? And on which A would be making the interest payments for the infinite period. Now, because in this case, what is happening? Debt repayment is happening or not? No, debt repayment is not happening, but interest on debt is being paid on a regular basis. Yes or no?
Yes, sir.
Now, because the interest payments are happening, can they be regarded as a net investment? This debt is regarded as a net investment in that case.
Yes, sir.
Why? So, interest payments are happening on a regular basis, right? And you are saying that that will be regarded as a net investment. So, what is the logic?
Sir, it is a not repayment of the principal debt.
Correct. So, when we say the payments are neither planned nor likely to happen, those are we talking about the principal or the main item, right? But if there is any interest or dividends being paid on a regular basis, that doesn't mean anything, right? So, interest and dividend payments, even if they are happening or not, doesn't matter. The only thing matters is whether the repayment is happening or not, correct? And hence it will be treated as a net investment, right? Now, how we are going to articulate this? Yes, as per the Ind AS 21, net investment in the foreign operation is the amount of the reporting entity's interest in the net assets of that operation. As per para 15 of Ind AS 21, an entity may have a monetary item that is receivable or payable to the foreign operation, an item for which the settlement is neither planned nor likely to occur in the foreseeable future, in substance a part of the entity's net investment in the foreign operation. Such monetary items may include long-term receivables, right? Long-term receivables as well. So even if you had a receivables which you are not planning to recover from the other entity, that could be treated as a net investment, right? Or any loans which are given on a long-term basis, they do not include trade receivables or trade payables, which are generally recoverable within the next 12 months or within the operating cycle, right? So general trade payables, general trade receivables are not part of the net investment unless and until they are long term or not nor planned to be settled in the foreseeable future. Analysis on the basis of above mentioned guidance. Though the origination of the perpetual debt A has made a permanent investment in B, the interest payments are treated as interest receivable by A and interest payable by B, not as a repayment of the principal debt. So, interest payment, even if they are happening on a regular basis, doesn't mean that the repayment of the loan is happening. And hence, because of this, since the repayment of loan is not happening or neither planned nor likely to occur, in the foreseeable future, the perpetual debt can be considered as part of the net investment in B. In accordance with para 15 of Ind AS 21, the foreign exchange gains and losses should be recorded in the equity at the consolidation level. Correct? So it will be recorded in equity directly. Clear?
Yes, sir. Clear.
Any questions? Any doubts?
No, no, sir.
Okay. So we have one more question for this, the practical question. Let's start this one and we will take a break after this. Okay. Infotech Global Limited has a functional currency of USD and needs to translate its financial statements into the functional and the presentation currency of Infotech Inc. L dollars. Right? So USD is the functional currency of Infotech Global, and they need to translate their financial statements from functional currency to the presentation currency, which is L dollars. So USD to L dollars, the translation is required to be done. The following balances appear in the books of Infotech Global Limited at the year end prior to the translation. So, property, plant, and equipment in USD, receivable in USD, total assets, issued capital, opening retained earning, P&L, accounts payable, accrued liabilities, total equity and liabilities, right? Balance sheet tallied. The translate the above balances of Infotech Global Limited into L dollars ready for the consolidation by Infotech Inc. Share capital and opening retained earnings have been pre-populated, right? So share capital and the opening retained earnings are already given. Prepare a working of the cumulative balance of the foreign currency translation reserve as well, right? So you need to give a breakup of the for FCTR, whatever is it is after the translation is done. Relevant exchange rates are a rate at the beginning. L dollar one is equal to USD 1.22 and average rate for the year is L dollar one is equal to USD 1.175 and year end rate is L dollar one is equal to USD 1.13. So I give you 5 minutes. Try to uh, come up with the translated balance sheet.
Okay, sir.
So you just translate the balance sheet into the L dollars using these exchange rates and the guidance. Okay. I give you five
Okay.
minutes. Okay. Any luck with the answer or the translated items?
Yes, sir.
So let's see uh, how the translation is happening, and then you can match if you have done it correctly or not. So translation of balances we need to present in a tabular form, right? For the easy understanding of the examiner. So whatever we are given in the in the examination question, right? So first column will be the same for the USD. Then the second column we will make up for the rate, and the third is for the translated balance, right? So property, plant and equipment, USD 50,000 will be converted at which rate?
Closing rate.
Closing rate. So 44 to 48 would be the translated amount. Why? We are dividing 50,000 by 1.13 because it is 1 USD is equal to 1.13 L dollars, right? So 1 L dollar would be 1 divided by 1.13 USD, correct?
Yes, sir.
Then same for the receivables, 935 into divided by 1.13, 827. Then total assets would be the total for 871, 682. I hope you must have arrived at the same number, correct?
Yes, sir.
Then issued capital is already given in the question, and opening retained earnings is already given in the question, correct? So 30, 0, 55, and 15 to 74 is already given in the L dollars, right? Now, profit for the year 20,000 at which rate? Weighted average rate during the year. So 20,000 divided by 1.175, correct? So 17,021 would be the profit for the year translated. And then accounts payable at the closing rate and accrued liabilities at the closing rate, and the total of equity and liabilities, right, is 847,306, correct? Then the translation reserve we will add, and our balance sheet will tally, correct?
Yes, sir.
Now, what is the working of this translation reserve? 24,376. So issued capital is 30,055 given in the question. But if we convert the issued capital as well at the rate, then it would be arriving at 44 to 48, right? So the difference between the two is 14,193, and opening retained earnings as well, right? 9,505, and profit for the year, right? 678. So 24,376 would be arrived at as FCTR. Now, how this is converted? So if we convert 50,000 at the closing rate, opening retained earning as well as the closing rate. Why at the closing rate and why not at the opening rate? Any idea? Yes. Why opening retained earnings? Uh, we are converting at closing rate.
Oh, no, sir. I could not recollect.
Not okay. So see, when we convert the balance sheet, right, on the from one currency to another currency, we need to use the translation rates of that very date on which the transaction has really occurred, right? And for the balance sheet items, it would be the closing rate, right? Now, retained earning is a balance sheet item or the P&L item?
Retaining is the P&L item.
So retained earning is a balance, right? So retained earning is coming in my balance sheet. Yes or no?
Yes, sir. From profit and loss account, we are moving to retained earning, that
Correct.
balance sheet.
Now opening retained earning means profits for the previous year, which have earned throughout the previous year, right? Now opening retained earning sitting on my balance sheet on the opening date is the profit for the previous year, yes or no?
Yes, sir.
Yes. Now that retained earning would be sitting in the form of bank balance, cash balance, or some other assets in my balance sheet?
Yes, sir.
Now, all those assets items are converted at what rate? Closing or opening?
Closing date.
Closing rate. So if we want to make a apple to apple comparison, at what rate opening retained earnings should also be converted?
Then it is a closing date.
Closing rate. So that's why we are using the closing rate here, right? Now, profit for the year 20,000. Now, this is also being converted at the closing rate from the balance sheet perspective so that I can say my issued capital plus my total retained earnings, opening plus earned during the year, sitting on my balance sheet. You know what that balance is. So if I convert this at 1.13, so these are the three items of the converted balance. So 44 is coming here, 2479 is coming here, and 17,699 is coming here. Correct? Now I already have this given in the question, this given in the question, and this I have arrived from by converting it at
Closing date.
weighted average rate during the year. Correct?
Yes, sir. Yes, sir.
So if these three set of items I match with these three set of items converted at the closing rate, the delta I will be able to calculate 24,376.
Yes,
And
sir.
this delta is nothing but the foreign currency translation reserve, FCTR, right? Because see, my balance sheet has two components. One is the assets and liabilities, and the another is the shareholders funds. Shareholders funds has two components: issued capital plus retained earnings. Yes or no?
Yes, sir.
So whatever is the foreign exchange gain or loss arising on this set of assets and the set of liabilities will eventually be compensated by what? Shareholders funds.
Yes, sir.
Correct? So that's why it is being adjusted in FCTR, right? So this is FCTR is nothing but part of the other reserves, and other reserves part of the other equity, correct? Which is a part of the shareholders funds. So this is how the FCTR working will be looking like. Now, what are the key learnings from this question? So the key learning is, first of all the balance sheet items will be converted at the closing rate while doing the translation from one currency to another. We need to pay attention whether the rate will actually be multiplied or divided for the right conversion. So we need to understand how the dollar to L dollar or L dollar to dollar or whatever the two currencies given in the question are related to each other, right? So multiplication and division, if mistaken, then it will fetch you the zero marks, right? In spite of you spending 30 minutes on that question, right? So we need to be very careful
Yes, sir.
how the conversion is to be done, right? It's not always multiplication. It can sometimes be division as well, right? Basis on the correlation between the two currencies. And the third, foreign currency translation reserve, we need to present, and that we can present in the tabular form in this fashion, right? So whenever we are going to provide solution for any translation of balance sheet, so this three columnar presentation would be advisable, right, for easy and quick understanding of the examiner. Clear?
Here the USD dollar is weaker, L dollar is stronger.
Correct. Okay, so let's do this last small question before we go on the break. On 30th January 2001, A Limited purchased a machinery of $5,000 from the USA supplier on the credit basis. So A Limited is purchasing a machinery from USA in the dollar for $5,000 on a credit. A functional currency is INR. Exchange rate on the date of the transaction is $1 is equal to 60 rupees. The fair value of the machinery determined on 31st March 2001 is 5500, right? On 31st March, fair value of the machinery becomes $5,500 against the $5,000 for which the A Limited has purchased. The exchange rate on 31st March is $65 to 1 rupee, $1 to 65 rupees. The payment to the overseas supplier is done on 31st March 2002. That is the next year. The exchange rate on that date is $1 to 67 rupees. The fair value of the machine remains unchanged for the year ended on 31st March 2002. The tax rate is 30%. A Limited follows the revaluation method under India 16. India 16, are you able to recall?
Yes, sir.
Cost method, revaluation method are the two accounting policy choices given in that question, in that standard,
Yes.
right? So
Yes,
the
sir.
company has opted for the revaluation methodology, right? For the property, plant and equipment, you need to pass the journal entries for the year ended 31st March 2001 and 31st March 2002 according to India's 21. Now, why according to India's 21? India's 21 has become effective because the transaction is happening in US dollar. Had the transaction was done in INR only, then there was no role of India's 21 here. Correct?
Yes, sir.
So just try it once, uh, basis on your understanding, and then anyway we will see the answer.
Okay, sir.
Yes. Ready with the answer?
Yes, sir.
The first entry. What would be the first entry for the purchase of machinery on the date of transaction?
$5,000 into that rate of the exchange is 60, 5 and 6 lakh, 3 lakhs rupees. Machinery account debit to creditors account.
Correct. So machinery to creditor account,
And
right?
immediately we are doing, yes, sir. Also, we
Then,
have done the revaluation on the revaluation we have done.
hmm, right. Now on the year end date, which is the 31st March 2001, because we would be needing to do the revalue of the machinery, right? So what would be the revaluation? So first of all, we will calculate the rate difference. So the dollar is 65 now against the 60 on the date of the transaction. So 5 rupees delta, correct? So 5,000 into my 5 rupees, 25,000 is the exchange fluctuation. So this will be recorded where? In the P&L, profit and loss account debit to creditors machinery, correct? So this is what the creditor reinstatement on the closing date. Creditor is my monetary asset, yes, or monetary liability, yes or no?
Yes, sir.
So I need to reinstate. So I have reinstated that. Now, for the machinery to be revalued, 5,500 is the new value of the machinery, right? While the old value was 5,000. So $500 is the increase in the value of the machinery itself, correct? So 5,500, the new value, minus $5,000, the old value, into may the transaction date exchange rate, 60, correct? So what would be the amount? 30,000. Machinery to revaluation surplus OCI. And again, there is a exchange rate fluctuation as well, right? So 5,500 into May 65 minus 65 rupees. So 27,500. So total change in value of the machinery would be 30,000 plus 27,500. Correct?
Yes, sir. What I have done is I used 65 rupees. I
Hmm.
put that for 57,500
So
consolidated way
So
instead
this
of
is
the split.
just to showcase that what is the real value enhancement and what is the forex impact, right? Although the total value would anyway be recorded, so either you can record it one go or you can split it to showcase that what is the real value enhancement and what is the forex enhancement in the overall fair value gain, right? Then the revaluation surplus OCI to DTA liability you need to create. The tax rate is given in the question at 30%. How much that would be? 57,500 into 30%. Correct?
Yes, sir.
So why 57,500? 30,000 plus 27,500. The total fair value gain on the machinery, right? Into the 30%. So that is the deferred tax liability which you need to hit in the books. Correct? On 31st March 2002, what would be happening? So there is no further increase in the fair value of the machinery. However, there is might be a change in the exchange rate, right? So again, because the exchange rate is getting changed, I need to reinstate my creditor being monetary item, correct? Also, because the settlement is also happening on the very same day, so I can do it in one go. So creditor 5,000 into my 65, 325, and to bank 335, and why 10,000 is parked as PNL? Because now payment is happening at the $65, 65 rupees per dollar rather than $65. 65 rupees per dollar, correct? So 2 rupees additionally I am paying to the creditor because of increase in the rate, right? So this 10,000 will immediately be debited to the PNL, right? And bank will be credited by how much? The total amount 325, the original creditor balance sitting in my books of accounts plus 10,000 reinstatement. So 335 is being paid out. Is this entry clear?
Yes, sir.
So this entry could be done in two pieces as well. First of all, you could have reinstate the creditor and then make the payment. But combined entry we have done here, right? Then machinery account debit to revaluation surplus. Again, 65 is the rate. Say, was the rate at which the machinery was revalued. Now it is 67. So 5,500 into 2 rupees. 11,000 would be the revaluation surplus, which we need to record on the machinery as at year end. Correct?
Yes, sir.
Then revaluation surplus OCI to deferred tax liability 11,000 into my 30%. 3,300 you will again record the DTL. Yes or no?
Yes, sir. I missed on that DDL portion, sir.
Okay. Rest all you have done correctly. Correct?
Yes, sir.
Perfect. So DTL, if tax rate is given in the question, we need to include the journal entry for the deferred tax liability as well. In case the tax rate is not given in the question, then we can skip on that in the examination. Clear? Yes, no?
Yes, sir. Got it.
Okay. So let's do a break now first. It's 8:44. Let's be back. Uh, how much time? 10 minutes would be sufficient. Let's be back by 8:55. Break started. Okay. So one last question on India's 21. On 1st of January 2002, P Limited purchased a machine for dollar 2 lakhs. The functional currency of P is rupees. At the date exchange rate was dollar 1 to 68. P Limited is not required to pay for his purchases until 30th June 2002. Rupees strengthened against dollar in the 3 months following purchase, and by 31st March 2002, the exchange rate is $1 equal to 65 rupees. CFO of P Limited feels that exchange fluctuations would not affect the financial statements because P Limited has an asset and a liability denominated in rupees, which was initially the same amount. He also feels that P Limited depreciates this machinery over the 4 years, so the future year-end amounts won't be the same. Examine the impact of this transaction on the financial statements of the P Limited for the year ended 31st March 2002 as per the Ind AS. So basically, what we need to do in this question, we simply need to make a record of the machinery charge, the depreciation, right? And reinstate the creditor. Correct? So these are the three items which we need to do. So how we are going to do that? As per India's 21, the asset and liability would initially be recognized at the rate of the exchange in force on the transaction date, that is the 1st of January. Therefore, the machinery would be recorded at dollar 2 lakh into my 68, 1 crore 36 lakhs rupees, right? So this would be the cost of the machinery at which the machinery will be recorded, correct? The liability, that is the creditor, uh, translated using the exchange rate as at 31st March 2002. That is the reinstatement of the creditor. So creditor is for how many dollars? 2 lakh dollars, because the machinery was worth 2 lakh dollars. Into May, the new rate 65. So 1 lakh 30,000. So initially the 1 crore 36 lakh was the creditor balance. Now because the rupee has strengthened from 68 to 65, so the liability is reinstated at 130. So 6 lakh is the saving on the liability. So because liability is reduced, so it is a gain. So the gain on the reinstatement of the liability of 6 lakh will be recorded in PNL. Correct?
Yes, sir.
Now, the machine is a non-monetary asset carried at historical cost. Therefore, it continues to be recorded at $68 only, 68 rupees only to $1, because machinery is a non-monetary item. It is not required to be reinstated every year. Correct? Only the monetary items are reinstated. Depreciation 1 crore 36 lakhs into May. 3 months, 3 by 12 into में 1 by 4. Life is 4 years. So 1 by 4 into में 3 months divided by the 12 months. Right? So 8 lakh 50,000 would be the depreciation which will be charged to the PNL for the year. Right? So January, what is the date of the transaction? 1st of January. Right? So January, February, March. 3 months we would be calculating the depreciation. Right? So 3 divided by 12. And the life is 4 years. So 1 divided by 4. Correct? Now, what would be the WDV? 136 minus depreciation 127. Right? Easy.
Yes, sir.
Okay. So let me. Is my screen visible for India's 37 now?
Yes, sir.
Okay. So the next topic is India's 37 provisions, contingent liabilities, and contingent assets. Right? And I hope you must have attended this NDS in your regular session, where you must have studied how and when the provisions needs to be recognized in the books of accounts, what are the conditions and criteria which need to be met for the provisions recording, what contingent liabilities means, how they are disclosed, and what contingent asset, the new item which we have never studied before under the IAM, right? So a small quick check. What is the contingent asset? Yes. What is the contingent asset? Because this is the new item, right? Provisions, contingent liabilities we have been studying since ages, but
Yes,
this is
sir.
the new item.
Contingent asset is a possible asset arising from the past event to be confirmed by the future event, not wholly within the control of the entity.
Perfect. Perfect. So contingent asset is similar to contingent liabilities, right? Contingent liabilities are, possible obligation, and contingent assets are possible asset, right? So as and when they become probable, they will be once they are becoming certain, they will be recorded as an asset. Until then, because there is a possibility that we will receive something from somebody, hence it is a contingent asset and not an asset. And as long as it is not an asset, it will not be recorded and will only be disclosed in the notes to accounts. So contingent assets are not recorded like contingent liabilities on the books, but they are only disclosed in the notes. Is that clear?
Yes, sir.
So let's do the question number one. U Limited and F Limited are partners of a joint operation engaged in the business of mining precious metals. The entity uses jointly owned drilling plant in its operations, right? So U and F are joint venturers. They are doing a mining business together and using a um, uh, jointly owned drilling plant for the said purpose. During the year end 31st March 2003, an inspection was conducted by the government authorities in the mining field. The inspection authorities concluded that adequate safety measures were not followed by the entity. As a consequence, the case was filed and a penalty of rupees 50 crore has been levied on U Limited and demanded from U Limited. The legal counsel of the company has assessed the demand and opined that the appeals may not be useful and the appeal orders will be unfavorable to the joint arrangement. Out of the 50 crore to be paid by U Limited to the government, 30 crore is to be reimbursed by F Limited to U Limited later, as per the terms of the joint arrangement. At the year end, actual reimbursement was not received from the F Limited. So, what is the fact? The fact is, U and F are into the joint venture. They are doing the mining business together. They own a drilling plant, which they owned by both of them jointly. Using that, they have drilled something. Inspection has happened. Government levied a 50 crore penalty on U Limited for not following the appropriate safety measures. And lawyers of U Limited says if we go for appeal, we will lose the case. Hence, there is no point in doing any appeal. Let's pay 50 crores to the government and get out of it. U Limited wants to claim 30 crore from F Limited as per the terms of the joint arrangement. F Limited will be paying 30 crore once the 50 crore is discharged by U Limited. Right? As at the reporting date, the 30 crore is not yet received from F Limited by the U Limited. Right? Basis on this, what do you think? What would be the accounting and disclosures required?
Yes, sir. When the contingent asset to be recorded, there should be visually certain than the related asset. And in this case, that it's clearly stated that actual reimbursement was not received from the F Limited.
Hmm.
Hence, it should not be against. Also, the provision, no, whatever the liability you are going to do that, it should not be over and above that the 50 crore at any case.
Perfect. So, as per Ind AS 37, there are two things. Number one, whether we have the right to receive from F Limited or not doesn't matter. U Limited is the prime obligation, has the prime obligation to discharge the penalty, right? Because the demand is raised on U Limited by the government. So, anyway, 50 crore provision will be required, right? So you
Yes,
limited will
yes, sir.
record a provision of 50 crore in its books, correct? At least this is sorted, right? That provision of 50 crore will be required in the books of you limited, correct?
Yes, sir. It is a
Now,
liability. They have to
it is
record
a
it.
liability, right? Because you limited has the right to receive 30 crores from the F limited as per the terms of the joint arrangement, right? But that 30 crore will be recognized as a receivable from F limited, or it will be disclosed as a contingent asset in the books of account. What do you think?
It has to be disclosed, not to record it, because no, that reimbursement was not received by them.
Correct. So because reimbursement is not neither received nor the F limited has confirmed that they will be discharging this, so that contingent asset is no more contingent and is an asset. So until then we will continue to disclose it as a contingent asset in the books of you limited, right? Because the 30 crore is less than 50 crore, the original provisions, right? So 30 crore contingent asset can be disclosed easily. In case it is more than the original liability, then it can be disclosed up to the amount of original liability. So for example, in case 60 crore was the receivable from F limited against the 50 crore original liability, then contingent asset will also be disclosed at 50 crore only, correct?
Yes, sir. Restricted to only that liability.
Restricted to only the liability, right? So this is the conclusion. But what is the support for our conclusion? So as per para 53 of India's 37 provisions, contingent liabilities and contingent assets, when some or all of the expenditure required to settle a provision is expected to be reimbursed by another party, the reimbursement shall be recognized when and only when it is virtually certain that reimbursement will be received if the entity settles the obligation. The reimbursement shall be treated as a separate asset. The amount recognized for the reimbursement shall not exceed the amount of the original liability, which is recorded as a provision. In the statement of the profit and loss, the expense relating to the provision may be presented net of the amount recognized for a reimbursement in case the asset is virtually certain. If it is not, then it will continue to be recorded as the contingent asset only and provision recorded at the full amount. Clear?
Yes, sir.
Perfect. Let's do this one. X Cements Limited has three manufacturing units situated at three different states of India. The board of directors of the X Cements, in their meeting held on 10th of January 2000, decided to close down its operation in one particular state on account of the environmental concerns. A detailed formal plan for shutting down of the above unit was also formalized and agreed upon by the board of directors in the meeting, which specifies the approximate number of employees who will be compensated and expenditure expected to be incurred for the closure. Date of implementation of the plan has also been mentioned. Meetings were also held with the customers, suppliers, and the workers to communicate the features of the formal plan to close down the operations in the said state. The representatives of all interested parties were present in those meetings, evaluate whether the actions of the board of directors create a constructive obligation that needs to provide for a provision for the restructuring. What do you think? So the question here is whether a restructuring provision needs to be recorded in the books of account basis on the above facts or not.
Yes, sir. Needs to be
Why?
needs to be done, sir.
Why?
Here, they have the formal plan of restructuring. They discussed in the meeting, and all the relevant stakeholders, and they discussed. They formalized also and communicated to the parties as well.
So what is the
So it is very
criteria?
clear that uh,
So
criteria is that
okay,
uh, criteria.
give me a second. There are two types of obligations. One is the present obligation, right? One is the future obligation. Now, which type of obligation we are concerned about while saying that provision is required, the present obligation, correct? Now, present obligation can be arisen because of two situations or two types of obligations. Number one is the legal obligation. Number two is the constructive obligation, right? What is the difference between the legal obligation and the constructive obligation? Legal obligation is driven by the formal agreement laid out and signed by both the parties, or it is arising by virtue of any applicability of laws or regulations. That is called the legal obligation. And the constructive obligation is the obligation which is resulting by the action or the past behavior or setting the expectations by the action of one party to the another party, right? Now, in this case, the board of directors have conducted a meeting, that is the board meeting. In the board meeting, they have approved the restructuring plan, and restructuring plan is to close down one of the cement factory, right? They have identified the list of the employees, customers, and suppliers who will be affected by this shutting down of the plant. They have conducted a meeting with those customers, suppliers, and workers as well. They have come, all of them have were present in that meeting, and they have communicated that we are going to shut down on this factory, and hence customers are advised to make their alternative arrangements for their purchases of the cement from alternate suppliers. Suppliers are advised to look up for other companies to supply their raw material, and employees are advised to try to do the job hunt in another companies, right? As we are not going to retain you, right? So all the three affected parties were present and communicated, right? Although there is a no formal agreement has been signed by the company with the customer, suppliers, and workers. So what this obligation is categorized into, legal or the constructive?
It is a constructive obligation, sir.
It is a constructive obligation. Now, under the India's 37, is it mandatory that you must have legal obligation only to record the
No,
provision? No.
no, it's for
Correct.
both. If it is
Both.
a legal obligation, also we need to provide the provision. Also, here
Correct.
a constitutional
Now,
obligation.
correct. Now, constructive obligation, as I mentioned, arises by virtue of the action taken by the company, right? What is the action taken by the company? That is the conducting a meeting with the affected parties, customers, suppliers, and workers, and informing them that, boss, please make your alternative arrangements, right? We are closing down on this factory, correct? So, this is the constructive obligation the company has raised, that they will go ahead with the restructuring plan, and hence whatever the expenses they are going to incur on this restructuring needs to be provided for in terms of provision for restructuring, correct?
Yes, sir.
Now let's see, as per the India's 37, the conditions prescribed are, there should be a detailed formal plan for the restructuring which is present in our case, which the board of directors have approved in their board meeting. It should have raised a valid expectations in the minds of those who are affected by the entity's restructuring announcement, right? And main features of this plan have been communicated to them. Is it done? Yes. In our present case, they have conducted the meeting with the customer, suppliers, and the employees. They have announced that they are going to shut down the company, and they are advised to make their alternative arrangements. The board of directors did discuss and formalize a formal plan of winding up the operation in the above state. The plan was communicated to the parties affected, which created a valid expectation in their minds that Excellence will go ahead with these plans to close down the operations in the state. Thus, there is a constructive obligation. And once the constructive obligation criteria is met, it means a provision will be required to be recorded, right? So provision recording gets triggered either by a legal obligation or by constructive obligation, which is the present obligation, right? Now, present obligation means the plan is to be executed, right? Because it is already approved, hence it is a present obligation. Had the case plan was not yet formalized or not yet approved by the board of directors, then until the approval or until the formalization, we cannot say that there is a present obligation, right? In spite of the fact the company has conducted a meeting with the affected parties and communicated that they are planning to shut down, but because the plan is not yet approved by the board of directors, there wouldn't be a present obligation. So constructive obligation would be there, but it is not a present, hence provision wouldn't be required. So the criteria for recording a provision is present obligation arising either because of the legal obligation or because of the constructive obligation. Is that clear?
Yes, yes, sir.
So we will focus upon present obligation arising either out of the legal obligation or arising out of the constructive obligation. But if the obligation is not present but future, then provision would not be recorded. So provision will only be recorded for the present obligations and not the future obligations. Correct?
Yes,
Any
sir.
doubts? Okay. So let's do this one. U Limited is a large conglomerate with the number of subsidiaries. It is preparing a consolidated financial statement as on 31st March 2002 as per the notified Ind AS. The financial statements are due to be approved for issue on 15th of May 2002. Right? So financial statements are prepared from year end 31st March 2002 and will be approved for issue on 15th May of 2002. Following are the transactions that have taken place in some of its subsidiaries during the year. G Limited is a wholly owned subsidiary of U Limited engaged in the management consultancy services. On 31st January 2002, the board of directors of U Limited decided to discontinue the business of G Limited from 30th April 2002. They have made a public announcement of their decision on 15th of February 2002. G Limited does not have many assets or liabilities, and it is estimated that the outstanding trade receivables and payables would be settled by 31st May 2002. U Limited would collect any amounts still owned by G Limited's customers after 31st May 2002. They may have offered the employees of G Limited termination payments of or alternative employment or opportunities, right? So either they are planning to terminate the employees or giving alternative employment opportunities. Following are some of the details relating to the G Limited. On the date of the public announcement, it is estimated by G Limited that it would pay 540 lakhs as a termination payment to the employees, and the cost of relocation of the employees who would continue with the group is rupees 60 lakhs, right? So the employees who are terminated paid 540 lakhs, and the employees who will be continuing with the group are paid 60 lakhs. The actual termination payments totaling to 520 lakhs on made in full on 15th of May 2002, and the latest estimate of the total reallocation expense would be 63 lakhs. So 540 lakhs was the estimate which the company has made, against which 520 lakhs is actually paid, and 60 lakh was the relocation expense estimate against which 63 lakh has actually been incurred, right? So these are the facts. GE Limited has taken a property on lease which was expiring on 31st March 2006. The present value of the future lease rentals using the appropriate discount rate is 430 lakhs. On 15th of May 2002, GE Limited made a payment to the lessor of 410 lakhs in return for early termination of the lease, right? So 430 lakhs was the estimate against which 410 lakhs was the payment made. The loss after tax for G Limited for the year ended 31st March 2002 is 400 lakhs. G Limited made further operating losses totaling rupees 60 lakhs till April 30. So 60 lakh is the further loss incurred by G Limited, which is a uh, operating loss, and 400 lakh loss is the for year end 31st March 2002. Determine the provision that the company is required to make under the Ind AS 37. Okay, I'm giving you 3 minutes. Think through what would be the amount of the provision which the company needs to record as per the Ind AS 37 on account of this restructuring which is being carried out, whereby the employees, some of the employees are terminated, some of the employees are relocated. and a
Okay,
lease
sir.
rental is also getting terminated. See, sometimes what happens in the examination, there are hidden, in uh, other India's usage, which we don't find, at the first reading. So if we do very good practice for the examination questions for past examination, say last 5 years or 10 years, then we get the flavor how the questions are clubbed of multiple indices into the one question, right? So that is really required in terms of good preparation for the examination. So although while doing the questions in the classes or at the homework, we know for a certainty that for which NDS the question is, but in the examination there is no indication, right? So we need to find it out. So try to do examination questions, you know, in practice. Okay. Any luck with the answer? Amount of provision?
Yeah, yes, sir. Sir, here it is a constructive obligation is there.
Hmm.
Hence, we have to provide the provision for it, and it's a we known is a subsequent event. Actually, it's a event after accounting reporting period, and based on that, we have to provide 520 for that expenses. For this, again the provision would be for cost of fulfillment will be 410. Totally is 930 actually.
So which other Indias you have applied to arrive at this answer?
India is 10.
India's 10. So that's what I mean. So although India's 37 is the prime India's which is governing this question, but applicability of India's 10 is also hidden, right? In terms of arriving at the right answer. What India's 10 says, events after the reporting date. What do you mean by that? Those events for which conditions existed at the year end, but clarity has arrived after the year end. What type of clarity? The amount which is actually paid, right, to the employees who are terminated. So although the plan was to make a provision for how much?
520 for 540.
540. So 540 lakh was the estimated cost by the company, but eventually, after the year end, when the payments were made, it was all settled in 520 lakhs. And now, because we know for a fact that 520 lakh is the right amount for this liability, which has subsequently been settled after the year end. So, while preparing the financial statements for the year end, which amount we should consider for the provision? 540 lakhs or 520 lakhs? 520 lakhs.
520,
Because
520 only.
520 lakh is the final amount which has been actually discharged after the year end, before the approval of the financial statements. this information is available. Had this settlement done after the approval of the financial statements, then what would have been the provision amount in our books of accounts?
Then it would be for 540 only.
Then it would be 540 lakhs, right? Correct. So this is how the India's 10 role is played in arriving at the provision amount. And same for the another item. What was the another item? Property on lease, which was expiring on 31st March 2006. The present value of the future lease rentals is estimated at 430 lakhs, but it is settled for 410 lakh payment to the lessor, right? So the idea was, or the estimate of the management was that they would eventually be paying up 430 lakhs to the lessor, but the lessor has accepted 410 lakhs for the termination of the lease early, right? Early termination. So because this has also been settled before the approval of the financial statements, so role of India's 10 has also become important, and hence the provision in the books is 410 lakhs. So 930 lakhs is the total provision. Now, why we did not consider the 60 lakhs?
Sir, 60 lakhs, why we are not considering? It is a relocation expenses is not allowed.
Correct. So it is a clear statement by India's 37 that while doing the restructuring activities does not include relocation expenses, relocation of the employees, retraining of the employees, relocation of any assets or liabilities from one factory which is shut down to the new factory, right? So all those relocation expenses are not part of the restructuring expenses, and hence they are not required to be provided for. So when they will be recorded, as and when they are incurred. So 60 lakh was the estimate, but eventually the 63 lakh has been discharged after the year end. So what would be the entry? 63 lakh, because actual payment is 63 lakh, and when it will be recorded, only on the date when the payment is made or expense is incurred. So this is the expense not for the current year but for the next year only. Clear?
Yes, sir. Future expenses we will not record now.
Right. And what about the operating loss? This 60 lakh operating loss, what
So, sir,
to do?
operating loss, any business loss, we should not record it.
Correct. So if we are going to report or record or report the operating losses, then why we are recording it only for 22? Why we shouldn't be recording it for next 15 years or 20 years? Because operating losses are the losses which will incur in the future course of action, right? So they are not arising in the current year. So they are the future losses, and we are not going to record any losses as a provision in the current year, because if we start doing so, then how long we need to go for next 10 years, 20 years, 50 years, 100 years, what, right? So we shouldn't be recording any future operating losses as a provision, correct?
Yes, sir.
So that was all you must have discussed in your main classes while recording the provision. So let quickly revise the justification. A discontinued operation is one that is discontinued in the period or classified as held for sale during the year. The operations of G Limited were discontinued on 30th April 2002. Therefore, it would be treated as discontinued operation for the year end 31st March 2003. It does not meet the criteria for held for sale since the company is terminating its business and not holding it for sale. As per para 72 of India's 37, restructuring includes the sale or termination of a line of business. A constructive obligation to restructure arises when a detailed formal plan for the restructuring is laid out and the valid expectation has been raised to the parties affected by those restructuring plans. Correct? The board of directors of U Limited have decided to terminate the operations of G Limited on 30th April. They announced it on 15th of February, which raised the valid expectation, and they have proceeded with that plan, right? So they have started to implement this plan, right? A restructuring provision includes only the direct expenditure arising from the restructuring that are necessarily entailed by the restructuring and not associated with the ongoing activities, right? So the employees who are relocated and retrained will, whatever the cost we are incurring for that will not form part of the restructuring cost. The termination payment fulfill the above condition, and hence, as per Ind AS 10, events after the reporting date, events that provide additional evidence of the conditions existing at the reporting date should be reflected in the financial statements. Therefore, the company should make a provision for rupees 520 lakhs in this respect. The relocation cost will not form part of the restructuring, and hence it will be recorded as and when the same has been incurred, right? So there is no provision required. The lease which is getting early terminated, so whatever we are discharging as a compensation to the lesser will be recorded as a provision, which is again a 410 lakhs, right? So the total provision is 930 lakhs. So this is how we need to support our answer in the examination to get the full marks. Okay, let's do this one. A manufacturer gives warranties to the purchasers of its goods, right? So manufacturer is selling the goods and giving a warranty to the customers. Under the terms of the warranty, the manufacturer undertakes to make the good by repair or by replacement. So if the good is not meeting the expectations, then either that will be repaired because of the warranty, or that will be replaced with the new product, right? So this is the type of warranty the manufacturer is giving for any manufacturing defects that becomes apparent within the 3 years from the date of the sale, right? So 3 years warranty is being offered by the manufacturer. On 30th April 2001, a manufacturing defect was detected in the goods manufactured by the entity between the 1st of March 2001 and 30th April 2001. At 31st March 2001, the entity's reporting date, the entity held approximately 1 week's sale in its inventories, right? The entity's financial statements for the year ended 31st March 2001 have not yet been finalized. The separate categories of the goods require separate consideration. So, category 1, defective goods sold on or before 31st March, defective goods held on 31st March, and defective goods manufactured in year 2001 2002, right? State the accounting treatment for the above categories for the defected items. So, what do you think? The defective goods which are already sold on or before the year end, what you need to do for that? Do you need to provide a provision for that? Yes or no?
Yes, sir. It has to be recognized the provision. The reason is the present condition is exist.
Yeah,
Present obligation and condition.
correct. And the category two, defective goods which are not yet sold but lying in inventory on 31st March. Provision required or not? What is your thought?
Yes, sir. It is a manufacturing defect, sir. Definitely that that event after the end of the reporting period.
Mhm. No, no, no,
It
no.
is,
Not
say,
after the.
I mean to say that it's a defective goods held on so and so, but the event which is happened after this period, which is a adjusting event.
Okay. So let me give you more clarity. This is manufactured and sold in the year. This is manufactured but not sold during the year. And it is neither manufactured nor sold in the year, right? So manufactured after the year end, right? Now, in this case, because it is manufactured and sold, so there is a provision required, yes or no?
Yes, sir. Provision record, sir.
Yes. So for it, a provision is required because the goods are manufactured and sold and the defect is identified, right? In this case, what is happening? Goods are manufactured but not yet sold. So unless and until the goods are sold, there wouldn't be any warranty obligation arising.
No, it's not needed.
Okay, because warranty obligation is not there because the goods are not yet sold. So there is no warranty obligation. Correct? So provision is required or no for warranty? No. For warranty, no provision required because the goods are not yet sold. But because the goods are already manufactured and they are defective, so it means there is a inventory obsolescence. Yes or no?
Yes, sir.
So provision for inventory obsolescence required or not?
Yes, record.
Right? Provision for inventory obsolescence required. But provision for warranty is required or not? No, because the goods are not yet sold to the customer. Unless and until the goods are sold, how the warranty liability can be become effective? Correct?
Yes,
And
sir.
the third category, the goods are not manufactured in the year, rather they are manufactured in the next year, right? So they are not yet manufactured. So do I need to record a provision for the goods which I will manufacture in April?
No, sir, because the present obligation is not there. It's not
Yes.
a obligating event.
There is no obligation because whatever I will do in the future, right? I cannot record that today, correct? So, category one, defective goods sold on or before 31st March. If the customer has the option to purchase the warranty separately, then the warranty is the distinct service because the entity promises to provide a service to the customer in addition to the product that has the functionality described in the contract. In that case, the entity shall account for the promised warranty as a performance obligation and allocate the portion of the transaction price to the performance obligation. What do you mean by this? NDS 115. Are you able to recall? Revenue
Yes,
from
sir.
contracts with customers. Under
Yes, sir.
that standard, it is clearly specified that the revenue needs to be recorded basis the obligations identified and as and when they are satisfied. Until the performance obligations are satisfied, revenue will not be recognized. Now, one of the performance obligation could be the warranty obligation as well, right? Because if the customer has purchased the warranty from the company, it means that customer has paid the price for the warranty, right? And warranty, unless and until either settled or expired, revenue cannot be recognized. Yes or no?
Yes, sir.
Right? So if that is the case, then in that case, how the accounting will happen? It will be adjusted under the revenue Ind AS 115. But if the customer does not have the option to purchase the warranty separately, an entity shall account for the warranty in accordance with Ind AS 37. Right? So either it will be governed by Ind AS 115, it is separately saleable. If it is not separately saleable, then it will be governed by Ind AS 37. Right? And under Ind AS 37, how it will be calculated? Basis on the past data, how many items are having the minor defect, how many items are having the major defect, how many items are having the no defect, pro rata allocation, and then we will come up with the provision amount, right? And accordingly, the provision will be recorded, right?
Yes, sir.
Now, in the second situation, defective goods held, not yet sold. So, because they are not yet sold, there is no interplay of Ind AS 115 because customer does not exist. We only have the inventory and my inventory is defective. It means my inventory is obsolete. And for obsolete inventory, I need to record a provision for impairment, impairment of inventory, which is standard.
Ind AS 2, sir. Yes, sorry. Impairment of inventories is Ind AS 2.
Hmm. So Ind AS 2 governs about inventory, right?
Yes, sir.
But there is a Ind AS 36 as well, which requires the impairment of assets, right? Impairment we need to record. So if my inventory is defective, right? Defective, then what entity need to do? They need to recognize a provision in respect of the defective inventories. However, the entity should test the inventories for the impairment as well in accordance with Ind AS 36 impairment of assets. So first of all, we will record a provision for obsolete inventory and we will also run a impairment test. or under Ind AS 36, right? If there is any impairment loss as well. For this category, the detection of the manufacturing defect in April 2001 is an adjusting event after the end of the reporting period as per the Ind AS 10, and hence it provides evidence of a manufacturing defect in the inventories held at 31st March 2001. Right? So there is an interplay of Ind AS 2, Ind AS 37, Ind AS 36, as well as Ind AS 10. So 2, 36, 37, and 10. Four Ind ASs are playing their respective roles here. Clear?
Yes, sir.
Now, what about the defective goods which I am planning to manufacture in the next year? So, as at 31st March, the entity did not have a present obligation to make good any defective goods that might be manufactured in the future. Accordingly, on 31st March, the entity should not recognize a provision in respect of the defective goods which will be manufactured in the next year. Right? Clear? So there is no provision required for this because they are manufactured in April only. So the provision will be recorded in April only. Furthermore, Ind AS 10 is also not applicable because it is a non-adjusting event. That inventory was not uh, present on 31st March. So no condition existed on 31st March, right? So these are non-adjusting event, nothing to be done in 31st March 2001 financials. Correct? So we need to be very clear while recording a provision for the warranties. Okay. Next question. XYZ Limited offers a 6-month warranty on its small to medium sized equipment which can be put to use by customer with no installation support. The warranty comes with the equipment and the customer cannot purchase it separately. The equipment is typically sold at a gross margin of 40%. XYZ Limited made a provision of rupees 30,000 during the year ended 31st March 2002. Right? So these products are sold at 40% gross margin. Right? 30,000 is the warranty provision the company has recorded, which is approximately 1% of the gross margin. Right? Based on the past experience, it is expected that 1% equipment sold have been returned as faulty within the warranty period. Faulty equipment returned to XYZ Limited during the warranty period are scrapped and sale value is fully refunded to the customer. Assuming that the sales occurred evenly during the year, how should XYZ Limited evaluate whether any additional warranty provision is required on the equipment sold in the past as 31st March 2002? Had the warranty period been 2 years instead of 6 months, what additional criteria would XYZ Limited need to consider? So the question is very small, right? Very limited facts, very limited information, but there is hell lot of hidden information available if we read the question carefully and interpret what the question is trying to say. So question has used lot of related numbers. 1% of the gross margin, right? 40% of the gross margin. So goods are sold at 40% gross margin. Defective goods returned are equivalent to 1% of the gross margin. 30,000 is the provision amount company has recorded. Is there any additional provision company is required to record? What would have happened if the warranty period is extended from 6 months to 2 years? In that case, what additional criteria XYZ Limited would need to consider for the calculation of the warranty obligation provision, right? These are the facts. Do you want to give it a try?
Yes, sir.
Okay. I'm giving you 2-3 minutes to think through what exactly needs to be done. So the ask from the question is 30,000 is the provision the company has recorded at present against the warranty. Is the amount correct? If not, what would be the correct amount? That's the one ask. Second ask is if the warranty period is not 6 months but 2 years, then what additionally company need to consider for the purpose of calculation of warranty provision, right? So the sometimes, in the examination, questions appears to be very small, but they are tricky enough to make you spend more than the required time on them. So don't go by the size of the questions. So that's the learning from this. So what is the sales amount? Total sales for the year, if you got it right.
Sir, total sale here is 75 lakhs, sir.
See, in the question, it is clearly mentioned that warranty claim covers 1% of the gross margin, right? And the warranty amount is 30,000. So if 30,000 is the 1%, then 100% would be
30 lakhs.
30 lakhs. And the 30 lakhs is the 40% of the sales because this is the gross margin, 40%. So if 30 lakh is the 40%, then what would 100% be?
75 lakhs.
75 lakhs, right? So once we are arrived at the sales number, then how much products which are under warranty for the year end is
Only for 6 months.
only for 6 months. So 50% of 70 lakhs. So 37 lakh 50,000. Correct?
Yes, sir. They provided 30,000.
Now we need to provide a 1% of this sales. So it would be 37,500. But the company has provided only 30,000. So additionally 7,500 needs to be provided. Yes or no?
Yes, sir.
So question is simple and short. Answer is also simple and short. But the only thing is find out the hidden information, how to arrive at these numbers. Right? Now, in case the company extends the warranty period from 6 months to 2 years, then what it will mean? It will mean that the wholesale of 75 lakh will be under the warranty period.
Yes, sir. The total sale will be the warranty period.
Then 1% of that means 75,000.
They need to increase that by 45,000.
Then 75,000 minus 30,000, 45,000. So 45,000 would be the additional provision which would be required. And the last task of the question was, if the period is extended, warranty period is extended for to 2 years from 6 months, what additional criteria would require to be considered? That is discounting. Yes or no?
Yes, sir. We need to put the present value for the future payment.
Right? So in that case, because the information about the discount rate is not available, so we are not going to do that, but we will mention because the period of warranty is extended from 6 months to 2 years. Hence, it is more than 1 year, and hence it has a significant time value of money, and hence discounting of the provision would also be required. Assuming the 10% discount rate instead of the 75,000, how much the provision would have been? 75,000 into me 1 divided by or 0.909, right? So suppose this comes to say 70,000 minus 30,000 already given. So 40,000 would have been the additional provision in that case. Correct?
Yes, sir. For 2 years, 0.826.
For okay, so whatever is the discount rate, you just apply the discount rate, come up with that discounted number minus 30,000, delta would be additionally required. Correct?
Yes, sir.
So this is how we need to do. Question number 6. HVCL manufactures heavy equipment for the construction industry. An order for supply of 90 equipment was received from ABIL. The unit price was 190 lakhs for each unit. 64 units have already been supplied during the year and the balance to be supplied as at the year end. HVCL has 5 equipment in its inventory on the year end and remaining needs to be manufactured. HVCL considered the contract was onerous contract and therefore net realizable value of the inventory has been taken as a value of inventory on 31st March 2002. The management of HVCL contends that cost incurred towards administrative overheads, finance charges, R&D expense, sales overhead, headquarter expenditure, etc. are considered as a period cost and hence not considered for the purpose of creation of the provision. Hence, the same needs to be included in the same not need to be included in the computation of unavoidable cost. The management of HVCL has submitted the details of the costs that have been considered for the creation of the provision towards onerous contract. Number one, material cost. Number two, labor cost. Number three, overhead cost. Accordingly, provision has been made considering the above cost only. The value of the provision created for the remaining 21 equipment to be produced as per the working shown below. So cost is 199 lakhs, selling price is 190 lakhs. So differential is 9 lakhs, right? Cost per equipment, and hence 9 lakhs into my 21 equipments. So 189 lakh is the total uh, loss which the company will incur if they manufacture these 21 equipments and sell it across. Whether the company's accounting treatment for the cost of the creation of the provision towards onerous contract is in line with the Ind AS 37 requirements. So company is saying that because we are incurring the loss if we manufacture these 21 equipments, then whatever the loss we need to provide upfront, and that loss they have calculated at 189 lakhs. How they have calculated? The cost which they will be incurring for manufacturing minus the sale price, the total loss into the 21 equipments. What do you think? Whether the management's accounting is correct or not?
Yes, sir. They have correctly accounted, sir.
How come?
हाँ बोलो ड्राइंग ड्राइंग
Yes, yes. What is the reason behind saying that management is correct in its accounting? Because Ind AS 37 requires provisions to be provided for onerous contract as per para 68, right? So para 68 of Ind AS 37 says onerous contract is a contract in which unavoidable costs of meeting the obligations under the contract exceed the economic benefits expected to be received under it. The unavoidable cost under the contract reflects at least the cost of exiting the contract, whichever is lower, right? Either honor the contract or cancel the contract. Whatever the cost is lower needs to be provided for as a provision. Ind AS 37 provides that the amount recognized shall be the best estimate of the expenditure required to settle the obligation, which is the amount that an entity would rationally pay to settle the obligation at the end of the reporting period or to transfer it to any third party. In the case of the onerous contract, an amount that an entity would rationally pay to settle the obligation would be the lower of the compensation or the penalties arising from the failure to fulfill the contract or the excess or unavoidable cost of meeting the contract, right? Lower of these two. Because the question is silent on the penalties, so whatever the cost we would be incurring in honoring the contract will become the provision amount for the onerous contract, right? So that's what the company has done. So para 68 again says that cost to fulfill the contract comprises the cost which will be incurred to complete the contract. That is all the incremental cost of fulfilling the cost. For example, direct labor, direct material, and any other related overheads, right? So that's what the company has done. So they have computed the direct material cost, direct labor cost, and additional, variable overhead cost. They have included and they have came up with the amount, and they multiplied it for the 21 equipments, and accordingly said that if we go ahead and manufacture these equipment and supply, this much would be the loss we would be incurring, and hence because the contract is onerous, we need to provide the provision upfront, right? So management is correct in its accounting. So accordingly, HVCL has correctly measured the cost of the creation of the provision for the onerous contracts by considering material cost, labor cost, and any other material overheads. Further, HVCL is correct that the period cost will not be considered for the measurement of the cost of the purpose of the creation of provision for the onerous contracts, as they do not relate directly to the fulfilling of the contracts, right? So period costs are those costs which are anyway be incurred whether the company is manufacturing those additional units or not, right? So hence those costs will not form part of the provision for the onerous contract. Clear? Okay. The last question. On 1st of January 2002, the directors of the Johnson Limited decided to terminate production at one of the company's divisions. This decision was publicly announced on 31st January 2002. The activities of the decision were gradually reduced from 1st of April 2002 and closed is expected by 30th September. As at 30th January 2002, the directors prepared the following estimates of the financial implications of this closure. Redundancy cost 2 million, further expenditure 8 lakh, to retrain the employees who are not terminated, right? Eventually, the cost, redundancy cost paid discharged at 1.9 lakh and retaining at 8.5 lakh. Plant and machinery having the carrying amount as at 31st March 2002, 8 million will have a recoverable amount of only 1.5 million. And these estimates remain valid. The division under the contract to supply the goods to the customer for the next 3 years at a predetermined price, it will be necessary to pay compensation of 6 lakhs to the customer. And the compensation actually discharged on 31st May 2002 is 5 lakh 50,000. The division will be making operating losses of 3 lakhs per month in the first 3 months and 2 lakh per month in the next 3 months. The estimate proved accurate. The division operates from a leasehold premises. The lease is a non-cancellable with an unexpired term of 5 years. The annual lease rentals payable on 31st March in arrears are 1.5 million. The landlord is not prepared to discuss early termination payment. Following the closure of the division, it is estimated that Johnson Limited would be able to sublet the property from 1st of October 2002. Johnson Limited could expect to receive a rental of 3 lakh for the first 6 months period from 1st of October to 31st March 2003, and then the annual rentals of rupees 5 lakh for each period from 31st March 2004 2007. 4 to 7, right? All rentals are received in arrears. A discount rate, any discounting calculation should be performed using a discount rate of 5% per annum. You are given the following data for discounting at 5% per annum. So these are the discount rates offered. So for the year 1, year 2, year 1 to 3, year 1 to 4, and year 1 to 5. Compute the amount that will be included in the statement of profit and loss account for the year ended 31st March 2002 against the decision to close down the division of the Johnson Limited. So one of the division is being closed down. Certain costs are being incurred apart from this, lease rental property which will be sublet, and the discount rates for the lease rentals for 3 lakh and 5 lakh are given. So with this information, you need to come up with the provision amount which you will be recording for this restructuring activity in the books of accounts. So same, more or less the question is similar to what we have already done, right? Few minutes back. So first of all, whatever the estimate is, if that is trued up before the approval of the financial statements, then Ind AS 10 also becomes applicable, right? So against the 2 million, if 1.9 million is the best estimate, which is the actual liability discharge, correct? So we will consider the 1.9 million, yes or no,
Yes, sir.
right? Similarly, for the impairment of the plant and machinery, again 6.5 million is, although not strictly part of the restructuring provision, but by virtue of Ind AS 36 impairment of assets, it also needs to be recorded. So we will say, although it is not part of the restructuring provision, but by virtue of Ind AS 36, because the division is getting closed down and the PP&D recoverable amount is given in the question, which is less than the carrying amount, hence the impairment loss also needs to be recorded under Ind AS 36, correct?
Yes, sir.
So restructuring provision, impairment loss, and then for breach of contract, 0.55 million is the cost which the company has to pay. So this will also be required to be recorded, correct?
Yes, sir.
Now, in the year, there is no change. No change recognized in the year 2002 with respect to the operating losses. So operating losses, are we going to recognize? No.
No, no.
Right? So it doesn't matter what is the operating loss in the current year or in the future years, because they are anyway not considered. Now, for the lease rental termination, how we are going to come up with the amount? So discount rate calculation is already given in the question. So 1.5 million into my 4.32 and 0.3 million into my 0.95 minus 0.5 million into my 4.32 minus 0.95, right? How did we do that? Here it is. So for the year one, it is 0.95, right? And for the year 1 to 5, inclusive, it is 4.32. So 4.32 minus 0.95. How much? It will be 4.32 minus 0.95 into my 0.5 million. Why 0.5 million? Because it is given in the question. Here it is. Annual lease rentals of 5 lakh. 5 lakh means 0.5 million, correct? Yes or no?
Yes, sir.
For each period, right? So 3 lakh only for the first period, and thereafter it is 5 lakh. So 3 lakh only for the first period. So 0.3 million into my 0.95 for the first year, and 0.5 million into my 4.32 minus 0.95. 0.95 we have deducted because for the first year we have already considered the 3 million, right? And why 1.5 million for 4.32? Here it is. The annual lease rentals payable are 1.5 million, and these are the receivable 3 lakh and 5 lakh, right? So that is the payable. So payable minus receivable, the net obligation. Correct?
Yes,
Clear?
sir.
So with that note, I conclude the session for today. Any questions, any doubts you wanted to ask, I'm here to answer.
No, sir. Clear, sir. Thank you so much, sir.
Okay, then I'll
Thank you.
take the charge, sir. Thank you, sir, for the students. With this, we are going to have this was the second last session of your LVRC for your financial reporting. Especially it was earlier the last one, but because of your demand at Saminathan, you asked for India's 24 also to be scheduled. So accordingly, we have scheduled one more session of our revisionary class, that is on 21st December, Sunday, from 7 a.m. to 10 a.m. on related party disclosure. With that session, we'll be concluding our revisionary classes. So in case you still have any doubt, then you can attend our open house session, which is scheduled every Monday from 4 p.m. to 5 p.m. But in advance, just let us know that you are having queries so that we can come up. We just go through that and we save your time because examination is nearby. So we don't want you to spend additional time. So just take extra efforts. Be ready with your revision. Don't spend much on any question, because this is not the time to gain knowledge, this is the time to increase your marks. So increasing knowledge is going to help you in long run, but as of now it is that you have to increase your marks. So just in case you are not able to understand the question thoroughly, or you are stuck up with any point, just try to remember the steps. That is the tip for last leg, when you are in the last leg of your revision. Okay, in case still you have any doubt or you are lacking confidence, you just want to talk to us, let us know. We are having our open house session every Monday from 4 p.m. to 5 p.m. Okay, you can also mail to us. You mail me at shilpa@ici.in. Okay, any query, Manish, Saminathan, you have to from board of studies, you just let me know. We'll try to resolve it.
No, ma'am, it's very clear. Thank you so much, ma'am, for your support all the ways. Thank you so much, sir.
Thank you, sir. Thank you, sir. Thanks for
Thank
your
you. Thank you, ma'am.
thank you, sir.
Have a good day. Bye.
Good day, sir. Goodbye, students. Bye. Yeah.